Inflation has been steadily declining in recent months, prompting the Federal Reserve to begin the long-awaited rate cut campaign. The direction of travel is clear, and the timing and pace of rate cuts will depend on incoming data, the evolving outlook, and the balance of risks. In my last video, I explained why this is good news for bond prices due to its inverse relationship with interest rates. However, the impact of rate changes on the stock market is more complex. While stocks have typically risen in the 6 to 12 month period following the Fed's first rate cut, investors look at more than just interest rates. In fact, interest rates are a secondary concern for investors today. The key factors driving equity markets higher are corporate earnings and ongoing economic growth. So let's take a look under the hood at these key factors. First, corporate earnings. The government reading on U.S. retail spending in July increased a seasonally adjusted whole percent from just the month before. This was the strongest gain since January 2023. Because consumers continue to spend, we have continued to see growth in corporate profits. Another key factor investors are watching is economic growth. Because consumer spending makes up well over half of the nation's GDP, a common measure of economic growth, unemployment is a key signal for determining the path of the economy. Obviously, individuals will only continue to spend if they have the money or income to do so. The U.S. unemployment rate increased to 4.2% in August from 3.8% a year ago. While the increase is partly due to more people in the labor force, this will be something to watch as further increases could be a sign of economic contraction. But for now, consumer spending has continued. While there are many factors at play, rate cuts are historically good news for the stock and bond market. The stock market will exhibit some rockiness at times as economic data is released, likely exacerbated by the unpredictability of the presidential election. We maintain a positive stance for the market long term.